How credible is the pushback from Mester, Goolsbee, Williams after what we heard from the chair of the Federal Reserve on Wednesday?
Well, I think Powell himself had the chance for pushback in his speech, and he didn't do it at all.
Didn't do it.
So to me, that was really what you needed to hear. And from now, they're going to have to push back a little bit because it has been an absolutely enormous rally here, and they're pricing in a tremendous amount of cuts. And the financial easing that has gone on could call into question things. But I think overall, the inflation is on the right path, and they know it.
You were bullish credit before. Are you more bullish now?
I started to get a little bit weary of it, and I actually was on the show last time with Lisa. She said, "Are you actually adding while everybody else is cutting right now?" And I thought about it for a second. I said, "Well, I think 2024 is setting up really, really well." I didn't think we'd get it this quickly, though. I thought there would be a lot of companies that were pushing back on borrowing because it was so expensive. They were borrowing at 6.5% to 7%, and they didn't want to do it. Now they're going to be borrowing at 5% to 6%, and it's a little more tolerable. But I think overall, the technicals are going to be very good. We've talked about this wall of money coming out of T-bills and cash. That is absolutely going to occur. And with it, fundamentals are very, very good.
So are you more interested in investment grade, or are you going even into lower rated credit because you see, if there's going to be spread compression, well, join the party?
I think there's a party in a lot of different places, right? So I think it's all about your risk tolerance, but certainly continue to see upgrades in 2024. I think the high yield double B market looks very good. The triple B market, the fundamentals are very, very sound. And so overall, I think you can go down. I think if you look, still the triple C sector is challenged. I think it's had very good returns, but there are some landmines there. So overall, I just think that there's a lot of good opportunities, but where there are most is actually in the banks.
In the banks.
In the banks. So if you look at valuations, the financials are kind of in their 60th percentile cheap versus the industrials are at their 10th percentile. So there's not a lot of value on spread in industrials, but there's a lot of value on yield and on spread in the banks.
I'm just wondering how much this is dependent on the Fed following through with rate cuts in March. Is there sort of a feeling that if they do, this all works out, and if they don't, it kind of starts falling apart?
So March is probably not that important. How many times do they cut in 2024 is. So I think just if they go in May instead of March, or whatever, the summer instead of March, it matters a little bit. But I think it's all about just getting that that signal from the Fed that they are going to be there if they need to be, which we didn't have before. We were worried about that last mile, that the Fed was going to fight so hard for that final mile to get inflation from 3 to 2. Now they're telling you we're going to get there, but we'll do it at our own pace, and we're not going to wreck the economy in order to do it. And I think from a banking standpoint, that's very good because they were probably going to take the brunt of it if the Fed really did push for that final mile.
You've touched on this a little bit. Let's build on it. You talked about that wall of money. Can we talk about that wall of supply? What's going on with that wall of supply?
So the wall of supply, there actually is a fair amount of securities coming due this year in the investment grade market as well as high yield. But a lot of companies have elected to simply roll that or not roll that debt and actually just pay it down with cash. So because it's expensive to borrow, you're seeing less debt. So net debt issuance in IG in 2024 is going to be the lowest it's been in 5 years. So that's a huge technical positive. Now, if rates get low enough that more companies want to borrow, that'll be a little bit of an offset to that. But we are projected to see a significant decrease in net supply. 2025 is kind of when it starts to pick up a little bit more, so we're kind of looking out towards that. But overall, one company that I'm watching for the signal, if you want a signal to keep on your radar, is Microsoft. They bought Activision for $70+ billion. They didn't borrow a dime from the investment grade market. They borrowed like 30 or 40 billion from commercial paper. They have not termed it out at all because it's too expensive. If Microsoft taps the market, they're telling you we no longer think it's that expensive. That means you're going to see a lot more supply coming.
We've seen equity finance deals elsewhere in M&A as well. Is that supportive of what we've seen in credit? Has the approach to the credit market changed because of where rates are currently?
I think so. So a lot of the first two big M&A deals in the energy space, the Exxon and the Chevron, were both equity financed. You just had Occidental, though, say that they're going to be borrowing to do their recent M&A deal. So we're seeing a little bit of a balance there, but overall, when debt is expensive, people want to borrow less, or they should want to borrow less, and so far we've seen that. I'd be concerned if we start to see the trend move the other way and people just say, you know what, 5.5% is not that bad, because for a while there they would have been kicking and screaming at 5.5%, but when you got to 6.5 to 7, it doesn't look as bad anymore.
I can't believe Tom's not here. He's been asking everybody, every credit person who comes on, when are big tech going to start issuing bonds? Literally every single person. He's not here today, and you're like, well, watch for Microsoft to start issuing bonds. He's probably watching and incredibly excited. So you think that could unleash a significant amount of supply that could maybe be not as positive.
It would be a signal to me. I'm not expecting it, but if I do see that, Meta did borrow. Look at the coupons on a lot of these deals. You look at Google, they've got 2 coupons. You look at 2% coupons. You look at Meta, they're at like 4% coupons. Nobody in the tech world issued at 5, 6, 7%. If you start to see anybody issuing at 5, it tells you that the high quality company that has cash is no longer thinking it's that prohibitive. But again, we haven't seen it yet, but that's the signal we're waiting for.
Has there been a bias to shorter dated maturities?
Absolutely. So there's been about 15% of 30-year debt has been, or of debt has been in 30-year securities or longer. Historically, that it had been as high as 30% just a few years ago. So companies did not want to borrow at these rates for a long time. Everybody forgets companies cannot prepay this debt. It's not like your mortgage; you can just refinance it and say, you know what, I borrowed for 30 years. The rates have gone down. I'll roll it right into a new lower rate. They have to be stuck with that for a very, very long time. So companies don't want to borrow these rates, and a lot of pension plans and insurance companies are really starting to step into the market, and they have been for the last 6 months. Retail is finally getting on board, but it's really been the pension insurance companies been buying the long end, and that's been flattening credit curves.
Well, this is what I wanted to ask you. Help me. I'm in cash. I'm asking this for TK. I'm in cash and I need to deploy some of it. Where do I go? What are you telling people?
Well, it's been a good trade, is what we keep telling people. But until recently, until the last month, we always have to say it's been a good trade, but you got to find the next good trade. And I think it's kind of, do you need to crawl before you can walk? If that's the case, you got to go 2-3 years. 2 to 3 year corporate debt is really attractive, particularly in the high yield market. That is getting gobbled up. We think that that's going to just completely collapse here. 2 to 3 year debt is very, very safe, but go out to 5 to 6 year debt. If you like the rate for 6 months, you ought to like it for 6 years.
There you go, Bramo. Bottom line. If you like it for 6, you should like it for 6 years.